All right, stocks are rallying in the new year, and that usually means gold is falling. And in this case, the precious metal has now had its biggest two-day drop in almost a year. Silver was right behind it, losing the most in two days since early May. But our next guest says, hold on to your precious metals because the markets are going to retreat this quarter, or maybe buy even more. Joining us now is Gijsbert Groenewegen. He's the founder of Silver Arrow Capital Management, a hedge fund that focuses on precious metals, but also deals with other commodities. Gijs, thanks for joining us.
Welcome.
Now, we've been surrounded pretty much by bulls since this year started, and as the year came to an end as well. They haven't been wrong as far as the equities market has been concerned. You are a grizzly bear, a sky is falling kind of bear. Why?
Well, for the reasons I mentioned to you before, I think what's going to happen is that the market is going to rise to about 1370, and that coincides with the maximum retracement you can have in a bear market, which is about 78%. And that would bring you like from the 666.
March 9th of 2009.
Exactly.
Yeah.
So you would go to about 1370, the S&P, and that's a 78 retracement from the high to the low and then back up again. Yeah, from the, 1560 level to 666, and then a 78% retracement brings you to 1370.
But you're not all about the chart. It's not technical, right?
No.
Yeah.
But let me fit it in with what I think. Because if you look at the markets, if you compare it to 2007, what do we see? We have huge debt levels. We have huge deficits. We have a real estate market that is not really improving. And I don't deny that, there were some positive news out. We saw it in Europe. We saw it today with the ADP figures in the US. Definitely. But, on the other hand, also food prices are rising like crazy. I mean, we see really tightness in all the commodities, in the hard commodities and the soft commodities. Yeah. And what I think is going to happen going forward is that the middle class, which is already suffering, will suffer more. Why? Because, they have a larger allocation to food of the disposable income. So they have less, discretionary income to spend on, the consumer spending, which really determines GDP growth.
How much less, though? Because we just talked with Jonathan Golub, and he kind of seemed to shrug it off that it wasn't such a big impact.
He was saying food is just a negligible part of what you spend. I mean, You spend your money on housing, right? And food, because the free market has given us such cheap food, is easily affordable for everyone.
Well, first of all, it depends for whom. Yeah. It depends what, what your other obligations are and the payments you have to make. And I don't think that it's the same for the middle class or for the upper class. There's a big difference, or the upper sort of income levels. And I think this is only the beginning. That's why we haven't seen it yet. But I definitely think that, you see it. Look at the soft commodities. We see record prices. We see all-time highs or 30-year highs or whatever. And don't forget that at the moment we are 6.9 billion people in the world. Yeah? And there were some forecasts that we would go to 8 billion in 20 years. I think we will be at 8 billion in 7 to 10 years.
So are you going to say we're going to run out of food? Which is what Jonathan brought up as well.
We're going to run out of food. I think you will see much higher food prices going forward. Next to that, don't forget that we see extreme volatile weather, in the last couple of years. Look now at Australia, which is forcing coal prices much, much higher. Yeah. So we have huge flooding in Australia, which is the size of France and Germany together. So, these are... This is
why we come undone, basically?
Now, let's talk about, you got to have it be a short term, right? Come undone, in 7 to 10 years, we're all going to be dead. What about next month?
No, but, we were just listening to Dominic, which was talking about, the CBO forecast.
Right.
Yeah, and he was saying, well, listen, 1%, increase in interest rates, yeah, is the same as the defense budget, yeah? At the moment, interest rates are being kept artificially low, as a result of the quantitative easing too. Yeah, but we all know that people are wishful thinking, want to see an improvement in the economy, and see much higher interest rates. And that's also why a lot of companies are raising capital at the moment in the market, because the anticipation of much higher interest rates, and that's going to happen.
So come 6 months from now, come 8 months from now, come 12 months from now, where are we? What's going to be going on in the market? What's going to be going on in the economy then?
Well, I think, a lot of people see the higher interest rates as a result of inflationary expectations. I don't think so. I think it's a risk that's creeping into the markets. I mean, look at the munis.
Well, some like Jeremy Siegel see it as it's a healthier market that we want to see rates going up.
You could look at it that way, but you can also take the opposite view and say, listen, look at the deficits with the munis or the states. That hasn't gone away. And as the former speaker said, nobody wants to talk about it. So everybody's focusing on the positives, but forgets to put it in perspective to the rest. Because if we have, a cut of spending of 35 million, a billion, what are we talking about? The tax extension is 858 billion.
Yeah, it was only 35 million, by the way.
Exactly. Moody's was talking about putting the U.S. Treasuries on a watch list because of the tax.
Are you concerned about the AAA rating in the U.S.?
I definitely don't exclude it. The debt to revenue ratio in 2009 was worse in the U.S. than in Greece. Nobody looks at that.
I got to ask you about the next few months, because you said February, March, the next few months we could see a market collapse here. You still see it?
Because I think what we see is new money coming into the market. It's fueling the equity prices, and people are optimistic at the start of the year and whatever. But the main thing you have to look at is sustainability, and you have to look at the major overhang in the markets, which are debts, deficits, and the housing market.
So March, April, the market falls apart? Just got a few seconds.
It could be. I don't know. Timing is always the most difficult thing.
Well, yeah.
But I think it could. It's probably between February and somewhere in April, I think.
All right, so pretty soon.
And look at that 1370 level on the S&P.
All right, Gijs, thanks so much for coming and joining us. Gijsbert Groenewegen there from Silvo Aero.